Good morning, everyone. Thank you for joining. So I think this week we will do one session, and then next week, because it's Chinese New Year, so I think we will take a break. So let's kickstart with this week's session. So let's do a quick review first. This week, I think the market was quite okay. So it's up by 2.3% on the S&P 500. So finally, we get to see some green. And S&P 500 up 3.7%. So I think this is like there's a bit of bottoming kind of feelings now. So I think market is a little bit of FOMO, not too much. I think still okay. Chinese tech still can buy. It's always a timing type of questions that still can buy or not. So I think for those who already in Chinese tech, you understand the business, I think you can just you won't ask this type of questions. I think for those who ask this question, I think they try to cross-check against what's happening recently. So I also pull up some information on this question. So I think the biggest news, right, that's related to Chinese tech, right, is this headlines here. Jack Ma gives up control of Ant Group, restructuring China's largest fintech company to put it back on path for IPO. So I think the part that Jack Ma is giving up the control of Ant Group, I think this is true. So he really don't have the control, like he gave up the 53.46% voting power. I think this one is really good news for Alibaba shareholders, because this entire crackdown, it all started out with Jack Ma. Now it also ends with Jack Ma. So I think this is definitely good. And then aside from this news, there's another one that coming from the central bank. Ant Group revamp basically completed, says central bank official, in key steps forward for China's biggest fintech firm. So I think this one also a good sign here. But the part that I want to point out is that the part that say that Ant Group IPO will be coming back, this one is not true. I think it's not Alibaba, maybe it's Ant Group that actually came out and say there's no plan for IPO, at least in the near future. So I think this one we need to get it correct, because sometimes when there's news report, I think there are people who want to put on a narrative that because this IPO was pulled out, and then now because Jack Ma already gave up the control, so IPO will be back, right? So I think this is not true, because when there's IPO that time, I think we are talking about what, 200 or 300 billions kind of market cap. So it makes sense to IPO back then, but because all these rectifications, I think the market is not going to give them that kind of market valuations anymore. So it doesn't make sense for Ant Group to go for IPO. So the time is really different now. So in terms of the business, everything is a lot different compared to a few years back. So I think we need to be realistic. Don't bet on these IPO things. But as long as the crackdown, there's a full stop on the crackdown, I think at least on the sentiment side, it will get better. So I think if for those who say, okay, Chinese tech probably already bottom, I actually kind of agree. Even though in the past, when people ask this kind of questions, like, has the market bottom or not, I usually would say, don't bet on the market bottom, because you only need one bad news, and then we come back again, a new 52 weeks low, right? So I think at least for China tech, I really believe that the 52 weeks low, right, that one really serves as a bottom, at least from a sentiment point of view. That's just some commentary from my side. I don't know, Boonsong, you want to comment, because I know that you are investor on Alibaba, right? So over to you.
No comment. But the thing is, the Alibaba, the Ant Finance IPO, that one, I don't think we should look forward too much to that. But eventually, I think that will still happen, because there are quite a lot of stateside. I mean, even Temasek is invested, I think. So the possibility is there, but I don't know when.
Yeah, you want to comment anything on their fundamentals? Because I think in the past couple of quarters, I mean, we haven't really talked about the fundamentals for quite some time now. So you haven't paid too much attention to it.
I kind of give out on that. I didn't have too much expectations on Alibaba, like some of us. I thought that it would do well, do okay, not do well. But I don't expect a lot of profits or that. Maybe $100, that's extreme undervaluation. I don't think that's the case. I'm quite pessimistic because I think the challenge for Alibaba is to get out of China. Eventually, you'll start to look at Alibaba and how constrained it is only working within the confines of China. But That is not a worry right now for most people who are invested, but eventually it will be.
Yeah, I think I don't have anything to show on the quarterly earnings. I think we'll still wait for a couple more weeks for the Q4 numbers to come out. But based on last, let's say 1 or 2 quarters, I think their numbers actually isn't that bad relative to the share price, because share price dropped a lot. Usually people will expect like more bad news, but actually it's not that bad. But it's also not very good in the sense of like China economy is really in deep shit in the past, let's say 2 or 3 quarters because of the COVID. And the good thing is that the management mentioned that their result is bad because of all this COVID thing. And then if there's any reopening, it should be a big good news for Alibaba. And in fact, now this reopening has been ongoing. So we are still in this phase of adjustment to a reopening. I think if you can just look ahead for longer than 1 year, I think the results should be much better. So I think for Alibaba shareholders, I think can be more hopeful in terms of their financial result if you look ahead longer. So I think that's on Alibaba. Other, let's say Chinese tech other than Alibaba will be, for example, like Tencent. I think also their result isn't that, I mean, it's so I would say considered bad, but everyone is betting on reopenings. So reopenings, if you see good news, sentiment is back. So I believe that there's still more legs to run. I mean, borrowing some of this lingo from traders. If a recession happened this year, is this one of the most anticipated or predicted recessions? Anyway, most say it will be a mild one. What are your thoughts? Okay, I'll go first. This one, I would say that, this recession, let's say if we really get into recession by mid of this year, end of this year, I'll agree with this statement that this is the most anticipated one, because actually this recession topic is not just this year, right? It's all started out, let's say, from 1 year or maybe 2 years back already. Keep on listening or this recession thing. But I think all this is really just about narrative and about the news coverage, because if you really read news, right, and you pay attention to this, for example, like you really care about recession, you say, okay, if there's a recession risk, I try to stay away from the stock market and so on. Actually, every year there's all this noise one. So I just pull up something from all the past news, right? Just to give you some feel on recession fear. So this one, some headlines. We're not going into very details, just read the headlines, right? So if you recall, just early last year, February 2022, we all started to talk about all this US yield curve has been flattening or inverted yield curve, and this inverted yield curve always come before recessions, right? So you can look at all this. Then from the same news, some investor and strategists are starting to forecast a yield inversion could happen as soon as this year. Okay, this one did happen. In fact, right now, the yield curve is totally inverted, and it's really big inversion. It's not a minor one. And then it started out to talk about like the last time yield curve inverted was 2019, and then it can even predict a recession that's caused by pandemic. You see, there's this news, this joke to say that, oh, you see, yield curve inversion is such a good predictor that it even predicted a COVID crisis, right? So I think this is quite funny one. So that's 1 year ago. So if you go back to 2020 is the one that you don't hear so much about, like recession is coming, because 2020 itself is a big recession year. But at least if you go back to 2020, the bad news or the narrative was that we are in recession and we won't come back for 1 or 2 years. Okay, you see, economists warn that US GDP won't recover to pre-pandemic levels until 2022. Then, of course, if you fast forward 1 or 2 years, this is the 2020. This is 2019. So this big bar here, and then this is 2020 recession. Of course, you can see 2021 we all come back already. Means that this is what economists wants, right? Whoever, I don't know who is this economist. It's with an S, meaning that it's not just one economist. Basically, wrong predictions here, okay. Then again, this one, early 2020, IMF sees pandemic causing global recession in 2020, recovery in 2021. Okay, at least this is the right predictions. If you go back earlier, 2019, of course, 3 out of 4 economists predict a US recession by 2021. You see, even during good years, 2019 is considered a good year. You still have like 3/4 of the economists predicting a recession coming. They are not predicting coming in 1 year, but at least they give themselves like maybe 2 or 3 years time that recession will be here. Then again, during 2019, recession and the fear that another one is just around the corner. So then even during early 2019, people are predicting that, oh, it's even possible that we are in a recession now. Then go back to 2018, 75% of the ultra-rich forecast a US recession in the next 2 years. So you can get a feel, right? Like all these recession things, right? Is that every year during bad time, people will say, we are stuck with this recession for a couple more years. During good time, people will say, okay, we will get a recession in 1 or 2 years time, or even 2 or 3 years time. So if you care about all this narrative or about all this recession, it's always here one. You will never get away from this recession. So I think bottom line is that, yes, every year there will be people predicting recession. So if you want to ask, is there a recession that no one see coming? I would say no, it's none, zero. Because people who make recessions, right, is in the number of millions or even tens of millions. People make all this crazy prediction, right? So it's always that there are people who say, okay, market will be good for 1 or 2 years. There will be people who say, okay, we will get a recession. So confirm every year, every time when there's a recession, someone would have predicted it. So I think that's the things. Come back to this question is that yeah, if you listen to this kind of narrative and you'll be afraid, then I think too bad then you will just stay away for a very long time So I think don't pay too much attention to this. Pay attention to those things that is more predictable one. Say for example, like you take a chart of over 30, 40 years. Is GDP increasing or not? Is corporate earnings increase or not? All these things, I think this one is more predictable than recessions. So recession, it will always come on. So for example, like for those who pay attention to semicon sector, you can see that now we are in a downward. It's essentially a recession in semicon industry for those who don't know, because PC market, smartphone market is all down. So are we going to like predict these things before it happens and then get out and then get back in again? No, right? We just hold on to our portfolio of companies and then just ride through it. And then if you can ride through one recession, one bad cycle, you won't have problem to ride it back up, right? So I think that's the mindset that I'm trying to how to say, cultivate here. Okay. I'll stop here. Just over to Jay. I know you are on the call, right? So you have any comment on this or anything to share on your side?
Hello. Hey, thanks for answering the question. Yeah, I do agree that actually every year there will be people who are predicting such stuff. Because in every year there will be bears and bulls. So bears will have their thesis. It will predict like recession, global supply chain issue, blah blah blah. So I also agree that all these are just noises lah. Just interesting fact. I if I'm not wrong, usually post recession, right, the average return for the next 5 years is actually more than 100%. So as long-term investors, I feel that yeah, you're right. Just ignore all these noises and stick to your own investment plan law. And specifically for this year, yes, it could potentially be a most anticipated recession because yeah, so for this year, I think the voice for recession is much louder than the previous years. So if it really happens, I think it probably won't come as a huge surprise for most of us. If it doesn't really come, or if it's a super mild one, then I think it's also good for the stock market. Then anyway, the gist is, yeah, just stick to your investment plan. The market may just go up before we all know it. Yeah, that's just my thoughts. Thanks.
Thank you. Yeah, so I think for this, right, when we talk about recession, we're talking about like big macro. So big macros, there's always offsetting of different sectors. But if you look into specific sectors, I think you will notice that actually they all may not be moving at the same speed. Say for example, like just like I mentioned, semicon. I think semicon, especially the PC and smartphone market, is really down very big. So if you just take that as an economy, right, that one is already in big recession. But I think if you look at big macro, it's offset by some other sector that is not in recession. Just now before I hit the record button, our friend Patrick mentioned about energy sector. I mean, business in energy generally is still good right now. So I think that's like just one example that some sector is in good time, so it kind of offset. So we may not see like a typical textbook kind of like recession because job market is still doing good and so on. But if you look at specific sector, I think you will see more like a better pictures because some really isn't in a good time now. Before we move forward to the next questions, I just want to share a couple more macro news that just recently came out. So let's comment a little bit on that. Let me get into it. I think the first one is talking about the inflation. I think there's this inflation numbers that just came out is 6.5%. I think after that news came out, I think markets also didn't drop big, right? I think it's like the inflation number is really considered not bad. So I think that's my take on it. But I just want to caution, right? Because if you look into more details, right? This is the headline. This is a chart coming from the chart out. I think this is quite interesting because if you look at the headline inflations, right? Headline inflation actually was okay. But if you look at the core inflations, meaning that you strip out the inflation, the energy prices, actually the core inflations has went up a little bit compared to last month. So what I want to point out is that actually energy actually contribute to downward, like a drop in inflations in this month. So, but the thing is about energy is that energy can be quite volatile one. So if you are betting on energy prices to come down, to cool down the inflation, if energy prices suddenly went back out, right? So you will get a increase in the inflations. So I think sometimes it's worth to go in to look at the core inflations to get the feel that actually whatever like 6.5 inflation number that we see, which is a good number, is actually, it's not a full picture there. So I think at least for the central bank, they want to see like core inflations that came down, meaning that those services inflation, it should come down much more than what we have seen. So I think that's something to pay attention to. The other things, just like this headline here, right? So cooler inflation mixed with strong labor. So strong labor, if you look at the numbers, I think it's going down a little bit. So I think this one is something that's good in terms of like there's some balance when it comes to supply and demand of labor. So, but the number is 223K, which is still higher than the expectation. So I think this is something that support the entire economies now. So if this job growth is still positive, meaning that we are not going to see unemployment rate to shoot up sky high, right? So I think with this still positive number, recession won't come so soon, at least. So I think this is something about the news that came up recently. So just want to share with you guys. So let's go back to the questions. I saw that there's 2 questions on Tesla. Let me read it up. Tesla production capacity is approximately 2.3 million. How much has Tesla spent on setting up its EV factories to date? I think I won't comment too much on this. Let me go to the next question first. How do you read of the Tesla price cut, good or bad? Demand will increase, but means they don't have pricing ability. Okay, let's comment these 2 questions together as one. I think EV factories wise, I would say new EV factories, so far not much news except for the Indonesia one. But I think that one is still rumor at this stage. I won't comment too much on that. But when it comes to EV factories, I think what we should pay attention to is the Austin factory and Berlin gigafactories. I think these 2 factories already open, but in terms of wrapping up, I think they are still in the progress. So that's what we should pay attention to, because if they ramp up, right, the capacity can increase very fast. But 2.3 million, I'm not too sure if this is the right number, because their numbers is about like what 400,000 in 1 quarter, right? So if you just multiply by 4, I think it's like what 1.7 million. Maybe not too soon to hit 2.3. If you 2.3, maybe you talk about like ramping up for the entire 2023, you might be right. So I can't comment on these numbers here. Price cut, yes, I think let's go to the price cut, right? So I think this is very interesting because I think the price cut news isn't new. Like they have been announcing this for a couple of times. First, I think coming from the China one. So they announced a price cut. And then the US price cut is even more like bigger price cut as compared to China one. I think one example, one reason why you see here, this one, some models are 20% cheaper is because they want to fit into this EV credit. They want to be eligible for that 7,500 EV credit. That's why they do a massive price cut. And if you look at this after the price cut, right, they cut it and then they are eligible for that 7,500. After you get that 7,500, the price that you are getting for someone who is buying, let's say a Model Y, is really, really very attractive. So I think the interesting part is that their pricing strategy here. So it's very clear that for Tesla, they don't care about like so much about the margin part. They really care about like, okay, because we already brand up, we have the capacity brand up. So we really want to like increase the production, increase the delivery, and let's increase the scale of the entire business. Don't care so much about the profit margin, at least for 2023 and maybe even 2024. And let's the massive scale, massive increase in the scale to help up with their cost, the unit cost. So with that, let's run, right? They could start with a very low margin for, let's say, 2023 or even 2024. But as they ramp up, right, there will be economy of scale and maybe from a very low number of profit margin. Once we enter 2024, 2025, I believe that net margin can increase. Meaning that we don't know what's the profit margin for 2023 and 2024 because you have a massive drop in the net margin because of all this price cut. Then from there, the margin will bottom and then it will increase now. I think that at least that's my interpretation on what we are going to see. But we just don't know, like so-called this bottoming of the net margin, how low can it be? Can it drop to, let's say, like because we started out with, I don't know, like lower than 20%, right? Let's say 16%, right? That 16%, it can come to, let's say 5%, or it can come down to negative 5%. I really don't know these numbers because there's so much into it, right? There's input prices there. There's different model, different margin. What is the allocations, like the sales, how many cars they sold in each all these segments, right? So there's a lot of noise in there. I don't want to predict this number, but we should all ready to see that this number will be lower, okay? Whether it's 5%, negative 5%, negative 10%, I don't think it's negative 10%. That will be quite shocking for me. But at least we can expect to see that, okay, once we have this number, it should bottom in, let's say, 1 or 2 quarters, right? After that, it will go back up. That's my expectations. I'll just stop here first, just to see anyone have any comment or you have any questions to go into more details on this. Or Boonsong, you have any questions or Jay, you want to comment? Yeah.
Can I say? I think
yes.
his question is the full production capacity rather than the current build number. So it's probably 2.2 million capacity. Maybe that's what he means.
Yep.
Yeah, so that's what I think it means. And has anyone done a calculation as to the actual revenue decrease from the price cut, like the average, weighted average price cut that is being done? Is it somewhere like 8%?
No,
5%?
I haven't seen such information. I think the harder part is really there's all these different configuration. Nobody knows the true breakdown. So for example, certain model drop by 20% to feed the EV credit. How many percent of the people will actually buy that, right? So I think even if there's such number, it will be just guesstimate. That's why I won't pay too much attention to this.
The only breakdown I've seen is the split between the premium ones, the 60,000 cars, which is the Model S and Model X, and the 3 and Y. The 3 and Y generally make about 90% of the actual selling volume. So so the 3 and Y, did it have the largest cut or is it the premium ones?
No. the big cut, I mean all the cuts, right? Is really 3 and Y. It is not the S, as in I don't know I don't know whether the S and X there's any cut or not, but the one that I've seen is really 3 and Y. So because it's 90% already, so let's assume that this cut will be applicable to all their cars lah. I think let's keep it simple.
Yeah, because their financial cost shows a 27% gross margin. So if you think about, let's say, 8% reduction, that would mean that the gross margin gets shrunk to about 20%, 21%. So that brings it in line with other auto manufacturers.
Yeah. So the one that you mentioned, I believe this is the one, the capacity. If you total up here, yeah, it's really 2 point something million. This is the one that's shown here. So I think that numbers could be right.
Yeah.
At least we have the adjusted EBITDA margin here. This is 23% here.
Yeah, the gross margin, automotive is 27.9. The one below. Yeah, you can see that automotive gross margin, that's their cost of goods.
Yeah. But what about the net margin? I was looking for I recall I've seen that in the past.
Well, I guess the net margin is going to be about 20%, 22%. Yeah.
Less than that, I recall. I think it's 16 or 17%. But at least we can see that. Like oh yeah, this one, the operating margin, at least we have this, right? So operating margin is 17.2%. So if every car they just cut by 20%, meaning that their operating margin will be 0. so at least this is the number that we have here.
Yeah, I believe what they did was the rear-wheel drive ones were cut the most, since I guess that the largest margin because of the cost was quite low. Maybe that's what they're doing.
This is a new questions. Was there any regret for averaging up into Tesla? Good questions. I will say no regret, because when I look at my portfolio, even though I bought some when it was quite high, but I bought it very small. Like when I look at my portfolio, I think when Tesla was at its peak, I probably have, I don't know, maybe 10%. Then after the 60 or 70% crash, I only left with about 3 or 4%. You know, my allocation to Tesla is even lower than QQQ, you know. So someone asked, like, can you just, I think someone mistaken my name when during this backholder pod, right? They say, I think during the discussion with, I think with Adam Khoo, they said this comment on the YouTube section, this guy actually said that Kelvin and Boon Tee didn't, like how to say, defend Tesla when talking with Adam Khoo. So I think he mistaken me with Eric, because Eric is the one that have much higher allocations into Tesla. Then I was saying that if I need to defend my Tesla allocations as I own like 5 or 6%, right? Then maybe even people like Mr. Lu, that he also have to defend because he bought into QQQ, which have higher allocation into Tesla. So I think that's the thing now. So just come back to this question, is that I don't regret because I have very small allocations. I think for those who really, like, if you have, say, for example, 20, 30, 50% allocation into Tesla, and you just keep on averaging up because you are too bullish, and suddenly after you have such a big allocation and then it dropped by 30, 50, 70%, of course, there's this feeling that's very tough, very, very bad feeling, because you have a big allocations and now you want to like bring down the average cost. It's very, very difficult as you have big positions. As for me, I have very small allocations. So it doesn't really have a big problem for me if I want to buy into it. I can let's say throw in, let's say 5,000, 10,000, then I can significantly bring down the average cost, right? If I want to. So that's why I will say I don't have much regrets there. Just to be frank. Yeah, I'm not the one that the kind of people that look into my position and then just calculate everything in details now. If you ask me this question on other positions, say for example, let's say Amazon, I would say the regret is a bit more, because if you compare my allocations, I have much larger allocations into Amazon when it was much higher. So I keep accumulating for some time, then accumulate a high positions. Then we get into this big drop in all the FANG names, right? So if you look at my P&L, Amazon is much larger than Tesla. So I would say that's bigger regret there. So screw up on the timing now, I would say. But still, as a big schemes of things like just step out, look at the big picture. My allocation into Amazon, is it big? Still not big, right? We're talking about what, 30,000s. If this position is like 100 to 200,000s, then I would say, yeah, it's much more painful. So I tend to see my portfolio, people who say, you shouldn't look at your portfolio. Say for your portfolio is, let's say, 100,000 or 50,000 now. You shouldn't look at it as a 50,000. Even if it is 50,000, you should look at your portfolio as, okay, these things, right? It is like 1 million portfolio. It just started out with 50,000. So we are still very early in the process. So if your portfolio eventually will be 1 million, you have 50,000, now you lose 50%, meaning that you lose that 25,000, right? It's actually 25,000 out of 1 million, right? So it's nothing there. So I think we should look at it that way. Like whatever loss that we are seeing now is just like very small. Yeah. So don't regret too much. Look at it from a big picture, meaning that we are just very early in the process. Yeah. We are going to build these things, right? Yeah. I have my own portfolio. You have your own portfolio. I don't know where are you now. You could be like, 20,000. You could be 200,000. You could be already 4 million. Even if you are 4 million, you're still early because eventually you will have a 20 millions, right? So still small. So don't be too negatively affected, at least on the emotional front. Our top investing guy. I'm outside now, so can't comment. But look at the Fed repo rate. So much cash on the side. Recession in the market will not happen. Investors are just looking at the risk-free rate for now. I think this is definitely true because with all this liquidity pumping, there are people who cash out and then just try to time it, try to get back to the market and so on. So I think every recession or every market crashes, right? They for sure there are monies on the sidelines. So that's why I won't be surprised that if you see there's FOMOing back, right? Then people will always come back into market, and then we get another rally. Whether the rally is a sustained one or it is a bull trap or not, that one hard to say. If anyone can guess it correctly, then everyone will be rich, right? So it's not that simple. So
but shouldn't you be looking at the risk-free rate all the time, regardless of what's happening? Because isn't that the basis of valuation?
I think that's the things, right? I won't pay so much attention to the risk-free rate. It's because when we invest, right, it's not like we want to invest or not invest. It's not like that. It's whether we want to put our money into, let's say, fixed income, or we want to put more money into stock market, which is higher risk, higher return. So it's always a trade-off. So when you decide whether you want to get into stock market or not, you basically is looking at the risk premium. How much risk premium that is priced into the market. So it's always like, okay, if I invest into like a government bond, say for example, government bond is, let's say, 4%, right? At least I need to have, let's say, 8% into 8% equity return. Then it makes sense from risk return perspective. So if the government bond is not 4%, it is 8%, for example, then at least you want to get a 12% from the equity markets in order to make sense, right? So of course, there's always a trade-off there to say that do we see this kind of risk premium price into the market or not? And then from our own personal finance, if you just invest into the stock market, if you just invest into the fixed income, is it enough to support your retirement plan and so on? So it's always a trade-off questions. It's not to say, oh, I just look at the risk-free rate, then I can decide already. It's not like that one. It's always a trade-off. It's always a risk-return trade-off, different asset classes trade-off. And then on your personal finance, is it something that like you get enough return or not if you invest in different asset classes? You look at what options that you have, and then from that option, you look at which one is appropriate for you. So it's always like that. It's not as simple as, oh, we all just look at risk-free rate. That's not how it works.
Boon Tee, Terence here, TU.B Investing here. So So I'm outside now. I'm not sure how clear I am, but
It's clear.
on the just on the risk-free rate, right? I mean, for retail investors, right, like us, Fed repo rate is now at $2.1 trillion. We probably wouldn't be even looking at 1% of the portfolio. I mean, our portfolio is not even 1% of that, right? So if we act in line with what the institution are doing, right, we will never be rich. That's my opinion. As in, if we are always in line with them, so they are going after risk free, we also go with them, right? I think we will always be average. So in my opinion, right, we should always be a bit of a contrarian in that sense. And I don't advise people to go against like getting T-bills and stuff like that. But I think probably have a balanced portfolio. Always go for it as a balanced approach. Then obviously that would be a better approach for retail investors.
Thanks for the comment. Yeah, I do agree that yeah, we contrarian wise, I do agree with you. We shouldn't like just look at just follow institutional side, they risk off, we follow them, then we will always lag behind, right? So a bit of contrarian in terms of decisions, I think that's the right approach. I do agree with you. It's just that whether we want to pay too much attention to what's the repo rate, what's the Fed doing, and so on. Maybe that's the part that I disagree a little bit now. It's just that I think we shouldn't, because all these things, right, it's not like to say it is useless when it comes to try to gauge where the market direction is. I think everyone who do their own tactical asset allocations, they try to time the market, they look at various different things. There's some truth in that. So different insights, you use the insight, you try to time it, you may get a good result. I won't deny that. It's just that for us personally, sometimes it depends on how much effort you want to place when it comes to like try to navigate these things. Like, do I really want to pay attention to repo rate, to Fed action, to interest rate, to inflation data, to GDP, to recession? Do I want to like incorporate all this into my own investment? Because for someone who want to incorporate that, I think it's fine. It's not like it's a wrong approach, right? There are like 5,000 different ways to invest. Of course, if you want to incorporate that and you know what you are looking at, of course, just go ahead. It's just that alternative to that is that people who say, okay, all these things, it come and goes. We always, there's a cycle, there's an up cycle, there's a down cycle, there's a recession, and then recession will end. Repo rate will go up and then it will down. Fed will do monetary easing and then they will tighten, and then they will ease again, they will tighten. So all these things come and back, and then corporate revenue growth, right? It up and down. So all these things, do you want to like get in, out because of all these various different indicators? It's an option, it's a choice that whether you want to do that or not. Because at least for me, right, I would say that because there are people who are very new investing, they will say that, wow, you are into stock market. So how do you navigate on all these things, right? Do you pay attention to this and that? I just want to throw these things out to say that actually there is a way for people who invest without looking at all these things. It's just that you trade all these things. It's not like they are not important. It's that, yes, all these things drive the market. It's just that they drive the market up and they drive the market down. As long as you have a horizon that is longer than 10 years, actually they average over time. So the plus will average with the down. So all these things, it will average out, become like a net zero. But what is not net zero is really the prosperity, the aggregate prosperity of all the humanity. Meaning that if you look at the global stock market, it tends to go up because GDP tends to go up. Our living lifestyle tends to go up over time. So you owning the stock markets, you own the companies, meaning that you have a stake in all this prosperity. Like businesses tend to grow, then those businesses that die out, of course they die out, but there will be business that they will prosper, and we want to own a stake of it. So over time, over 5, 10, 15, 20 years, we want to participate in all this, right? And one good way is, of course, you want to like don't want to stop pick, of course, is go through the index, and then you own a piece of it. So that's the things that is okay. You don't care about all these short-term things, right? Just go for the big trend, big growth. Then that's at least a low stress way of investing, meaning that you just turn off like all these short-term things. That's just one way. I'm not saying this is the only way. That's just one way that actually you don't have to know economy, you don't have to know Fed, you don't have to know inflation, you don't have to know stock picking. You can still invest, you can still own a piece of it now. Yeah, that's the thing that I try to share here. Okay, next question. Just curious, anyone managed to beat S&P index even during good times? I managed to beat S&P during good time. It's just that during bad time, I severely underperformed. I was down like 40% when S&P was down 19%. So I can proudly share that I underperformed S&P by 2x. And no shame in that, right? So that's the result. That's the result. I think if you do stock picks, right, one thing you have to accept is that you will outperform and you will underperform. The best investor, they still underperform during certain years. It's just the aggregate average over time. They manage to churn out this alpha like over, let's say, 5-10 years. They outperform. That's the definition of good investor. But doesn't mean that every year is outperformance, you know. But I think I would say good investor is that they can look at the bad result and they can accept that. It's not like, okay, you get a bad result and then you try to reason out it to say, oh, I blame this, I blame that. Then that's not a good habit. So at least be honest with yourself and then understand the situation. Because whoever who do this kind of stock pick, for sure you will have some bias, okay? So it's, for example, I bias into tech sector, YCX bias into energy, he likes energy, and then Boonsong bias into like very value picks and so on. So if you have certain biases in terms of like certain sector or certain picks or certain style, right? For sure your numbers or your returns will deviate from the average of the market. So there will be some years that the sector or the style that you investing in, right, is like outperform. Some years it will underperform, and you just need to be okay with that. You know, every style is like that. You won't find a single style that like outperform forever. One. By forever, I mean like outperformance for like consistently for every year for, let's say, 10 years. You won't be able to find it because if you are able to do that and outperform, then all this money will flow into it, and then it will be overpriced, and then it will suffer from underperformance. This is true one. Yeah. So I'll stop here first because I saw that Hayden just joined. I don't know whether Hayden can give some comment or not. So just now there's these questions talk about like China tech can buy or not. So I don't know Hayden want to comment or not. Maybe outside lah.
Yeah, currently outside.
Okay. It's okay. No, not convenient to speak. YCX is here. Any commentary on energy sector or you want to comment on Nvidia versus AMD or anything you want to share? It's been quite some time, haven't heard your voice. Or Maximus, you want to update us anything on REITs or any companies that you are paying attention to?
Chiking actually asked if that last year was like your first time having a bad result. So do you have anything to say about that?
Sorry, there's questions in the Telegram
chat. No, it's in the chat.
Oh,
it's asking whether this is the first time bad results for you.
From me?
Yeah.
Oh, okay. Okay, I can share that. Let's say, okay, let me just I know some people who just started investing, say for example like 2021, 2022. There are many people started investing. I think one reason is also because like all these Moomoo, Tiger, they all become like they spend a lot of money to do the marketing promotion during this period. And these people who just started out, let's say 2020, 2021 or 2022, you have a big red. So for me, right, this kind of experience, for me, this is not my first time. My first time was during the COVID crisis because my portfolio, at least the IBKR portfolio, which there's a proper tracking because there's all this report that coming out, right? I can see my performance. The first time I encountered this was like during, let's say, March 2020. So from 2017 until 2020, that was like what, three years I invested. And I look at the reports, come up with numbers that I don't know what, negative 30 or 40% drop because because of all these money weighted return and funny calculations. That was my down year because I basically invested for 3 or 4 years and then keep on averaging up, do the stuff that people say is the right way to invest, right? In fact, the first 2 or 3 years, I don't even have a single stock pick. I just buy index, like the global index, and then maybe like 2,000 or 4,000 into Berkshire as my pick there. Then it was down very big during COVID crisis. So definitely not my first time. So if you encountered like investing for a couple of years, suddenly you don't have a gain, right? You have a loss. That's normal. And if you have money to keep on averaging up, let's say after this recovery is back, you look at your entire portfolio suddenly become green, then you're happy, right? Then maybe you invest another couple of years, you have a big drop, meaning like the entire stock market is down by 40-50%, then you will come back to red again. So this is definitely like you should expect these things to happen now, because even like the recent one, it's not really a big down year. It's like 19% down for S&P 500. This is, I'll call it like it is a correction. It is not a big market crash. So when there's a big market crash, even people who invested for 7, 10, 12 years could still down to red one. So nothing's, it's not a big surprise. So I would just say this is part of investing. So there will be down years. It just, the good thing is that if during all these big down years, and if you have money to deploy into the stock market, and if you deploy big and you buy stocks during this period, and when the market recovery come back, then from there onwards, it will be harder for your portfolio to sink into red again because of the companies that you bought during depressed prices now. So I think that's the situation.
Hi, hello.
Hello. Finally,
Yeah,
we can hear
okay.
you.
Yeah, okay. I just like to say that because right now, when we look at Fed funds rate at around 4.5%, potentially reaching up to 5%, right? So if you think about the risk-free rate in terms of that, so it'll probably be around 5% risk-free rate terminal for now lah. I mean, as of today, if we look at how things will go. And what's going to happen in 17 days is that the Fed will most likely say the same stuff, which is that unemployment numbers are down. So therefore, we are going to rate up again, and we're going to maintain this course, and we're not going to pivot yet because unemployment numbers are still down. So we will just hold at this rate first until inflation is firmly down, because we have to remember that inflation is still at 6.5%, while Fed funds rate is at around 4.5%. So there's that lah, which is that there's still a way more to go. There's no need to be like, oh, I will have to all go into a certain thing right now and FOMO in before I miss out on anything. Just now is a good time to go in, but again, it's about what you want to go into, because at around like a risk-free rate of around 4.5 to 5%, if you think about it, it's actually a pretty good risk-free rate. And when you are looking at businesses that are, let's say you are not buying the index, okay, and you are looking at businesses right now, obviously in this kind of higher risk-free rate, right, means that it's harder to loan money, which means that smaller businesses are harder to, it's going to be harder for the smaller businesses to justify like setting up, because investors are going to be looking more towards what is your MPV and IRR, and is it higher than the risk-free rate? If it's not, I might as well just go with the risk-free rate instead of taking something so risky that may not even outperform that. So that's that lah. So like my opinion is that the bigger businesses now will, because they are more financially solvent and they have a better brand. So usually they are the ones that gain market share during this kind of periods, because people also tend to be more prudent with their financial decisions in terms of what to buy, because they rather buy something that is more associated with a brand that is reliable, instead of going through like those kind of like, I mean, risk is not just with risk of investment, it's also with risk of products. Like you'll buy a more reliable product compared to like a less reliable product. given the same amount of money and it's not significantly cheaper in price So there is that thing over there. So it's a good thing to actually build up positions on brands that are cheap for now, but you know that they will gain market share during this period. That's what my opinion. And also, I think you brought up a very good point on the energy being the main driver of the inflation right now. And in my opinion, that's one of the reasons why I go into energy, because it's as a hedge against the entire overall market. Because there is a lot of cash lying around, and the cash have to go someplace. Otherwise, they are just going to like rot due to the inflation. That's one aspect of it. And the other aspect of it is that because of this risk-free rate being what it is, it's important to more than ever now, right? Focus on the management decisions and what is their roadmap going ahead. That means like what is their roadmap 2-3 years down and what are the kind of returns that they are forecasting 2-3 years down. Because and of course also compare this to their historical performance and what is it that they say, and are they right on what they say over the years for those decades long companies Because the issue over here is that right now the risk-free rate is high. You have all these businesses that can actually promise things and of course they all have to promise above the risk-free rate at some point in time, like not now but maybe sometime in the future. And of course the risk-free rate may come down, that kind of things, and that will lift them all up together, right? But if let's say we go by what the Fed will say for the rest of this year, which is that they have not decided on pivoting yet, they are just deciding on where they will be terminal as long as the inflation rate comes down, then they might hold at that position for some time, right? Then we really have to look at the management and what they say regarding like how are they going to perform for the shareholders, because it's either you perform through growth in market share or growing your TAM, or you are growing through or you are rewarding shareholders by giving out more dividends or whatever kind of things to push up the stock price or give out dividends, this kind of things So I would say if you are investing in like stock picking kind of option, stock picking, right, then it's important to look very closely at their management reports and what is their guidance and what they say for their shareholders. That is the important thing that I focus on when I look at stocks right now. And also the other thing would be that what is their total debt to their, I mean, what is their what's that, the current assets, current liability ratio, the current ratios and all these, and their long-term debt, what is it right now? Because like companies that have a lot of long-term debt and not enough cash on hand to cover, right, they are going to also suffer through this phase and unlikely to reward shareholders value enough, because they still have to service their debt in that regard.
I got something to add regarding the question about beating the index. So while YCS was talking, I went through my Intelligent Investor. So if you know that book, at the back of it, you actually attach the records of certain so-called legendary value investors. So I would exclude Buffett because he beat the indices I think throughout his Buffett partnership years. But if you look at maybe Charlie Munger, who also had his own partnership, and I went to look at his records from 1962 to 1975. Do you know how many years he actually beat the index? His partnership only beat the index on the score of 9 to 6. So on 9 years, it beats the index, and 6 years it lost to it. But when you look at the average annual compound rate, right, the Munger partnership returns 19.8%, which is, I think a lot of us would love to have that kind of returns, whereas the Dow Jones returns only 5%. So it's not the number of years where you beat, but how much. Because you know that Munger had a very concentrated portfolio. So certain years he did very, very, very well, and certain years he did very, very poorly, especially between 1973 to 1972 to 1973. He actually lost to the index by average about 10. And in 1974, he actually lost to the index by 20%. But at the end of the day, you rather had a 19.8% than 5% compound. Yeah, even water straws lost to the index. Won the index by a score of 19 years to 8 years. Yeah, so you can't beat the index every year. Be happy when you have an outperformance. So for instance, when the indices return maybe minus 20%, and maybe you had a minus 10, I think it's a good result. It's a good result. And even Buffett during his partnership years would prefer that than maybe the S&P returning 20% and then he returning maybe 21% because his target is to beat the index by 10% every year.
Yeah, I think this one, if you look at all these like so-called great investor, you look at their past performance, you will notice that if they show their returns on every year, you notice that there will be certain year you see crazy returns, like 60%, 80% in some years. And once you average out, you get a very good average returns. That's always the case. And I don't think this investor, they are navigating this via looking at all this macro stuff. Really, they pick the good companies undervalued. So when all these sentiments or specific catalysts that push certain stocks high, right? So they get good returns on that now. Come back to because just now Y6 talk about like all these companies by brand, right? I just want to pull out something here because this week I think we are now entering into this quarterly financial results. So usually TSMC is one of the first one that came out. So I did read through the earnings call and just have a glance on their results. So I pulled out something that I find quite interesting. I believe that there are quite a number of investors who watch like who are in the Telegram group also pay attention to TSMC. So I just want to say for why I am like TSMC so much is because we can see that on the technology scene or technology space, there are a lot of things that's coming. For example, like all these ChatGPT and so on. There will be many startups that will be in this field, but we don't know like when it comes to software side, there will be tons of innovations, tons of different experimentation and so on. I don't know how to bet which one is the best one. I don't, because I believe the best one probably hasn't come up yet, So there will be a lot of all this innovation that will be coming over the next 10 years. But I know that whoever wins in this space to like AI and stuff, right? Those who benefit one will be like big companies, for example, like TSMC, NVIDIA, and so on. So that's why I like this company a lot. So come back to TSMC. If you look at this disclosure, they are so-called the leading edge process nodes, meaning the 5 nanometer and 7 nanometer is already like larger than the rest combined, the matured process nodes. And you can see that even for this, I think since last quarter, and for this quarter, you can obviously see that the 5 nanometer is much bigger than 7 nanometer already. So they already moved to the like 5 nanometer now. It's become like their bulk of their revenue contribution. And the 3 nanometer just started. So next quarter, we will see another different colors for 3 nanometers. And then you look at in terms of the percentage of wafer revenue by technology for 4Q 2023, 4Q 2022, I think this should be the right number. It's already at 32%. And what is driving their revenue is actually the HPC, high performance computing. If you look at these numbers, used to be lower in the past, but now the HPC is really growing fast. So I'm trying to guess like which companies actually like which clients are they servicing when it comes to HPC. I believe NVIDIA could be one, but I don't know the full details. So I just want to ask YCX, have you paid any attention to this? Do we know that is there any new product coming from NVIDIA that will be using the 3 nanometer or let's say the 5 nanometers that we kind of see that big revenue will be like new products or anything like that? Do you pay attention?
I mean, there is right now is the H100 and the H800 depending on whether you are in China or in rest of world. H800 is for China lah. H100 is for
Outside China.
Yeah, outside China. And anyway, I look through like the H800 and H100 specs. They are almost very, very similar. So it's like, in terms of like, the H800 is probably just to change some parameters to fit under the US classification that they can export it, that's all. Yeah. So there's that lah. And then in terms of like roadmap of wise, H100 I believe is on this 5 nanometer process, and it will be for quite some time. They wouldn't release a product, and I mean for at least for like this kind of HPC AI products, right? The life support is long, and also the marketability is long. If you look at how A100 has been around for like four years at this point already, so yeah lah, it is going to be a rather longer life cycle. And more importantly, it's not just about the process, because when you look at all these product stacks, right, which is that when you are a data center, you don't just get the best node or whatever, and then that's it. You actually have to look at what is the overall cost and the performance, and then also the amount of space you have, the electricity that you use, that kind of things, right? So it could be that data centers are still stuck on a more like not as cutting edge node, but rather on a more supported node that is actually cheaper, or a more supported product that is actually cheaper lah. Yeah, that's what I mean. So at that level, they are actually looking very closely at price and all the other factors, rather than at what is your node process and what is your technology, because they're not just buying one, they're buying like thousands kind of thing and setting up in that way. And as in terms of like what is like their roadmap of product release, right? That they actually NVIDIA actually does have the product release. It's just that the focus now is on the H100 for them. Just like and they will progressively now they are more about like selling the platform, which is that they decide that this is the platform that we are using, and then it's like Lego like that lah. Basically, you use this platform, then these are the best products that you can use together with it, and then you can scale up accordingly that way lah. You know? That is the way all these companies are going about doing these kind of things right now. For all of them, it's not just NVIDIA itself. Even for Intel, AMD, all of them are like that. And I mean, in terms of like, for me, when I look at these kind of things, I also look at like their take up rate, because usually once a data center sticks with a provider, right, they will stick with their provider for quite some time. It's not going to be like we stick with this provider for 1 year and then we change to another year, that kind of things. It's going to usually be like you get what I mean, which is that is a partnership kind of thing that you go with long term. That's all.
Yep. Thanks for the comment. So actually the H100 came up for quite some time already, because sometimes they announce first and then take some time to ramp up, right? I don't know whether this product, like they started to deliver it for how long already? Not more than 1 year, right? Okay. Y6, you are muted already, maybe.
Yeah, correct.
Oh, okay,
correct.
Okay.
It's around. There's always a uptake rate lah. It's not that fast one.
Okay. Thanks. Yeah, I saw this questions from Hayden. Any concern for TSM in regards to its capex? Its capex is closing into its operating cash flow, 46 billion versus 36 billion for now. So let me explain a bit of their business. So for TSMC, their capex, right, is like they spend the capex, and then all this capex, it will flow into production capacity, and the revenue will come in later. So if you compare the capex, which is for future production, versus their current operation number, which is like historical numbers, sometimes it can get a bit it's not comparable. So for example, right, they can just say, okay, right now their capex is, let's say, 20 billion. Their operating cash flow is 20 billions. If they see the demands, they can actually bump that capex to 40, 50, 100 billions, as long as this 100 billion, taking it as like an investment now, and is able to generate a lot of profits in the future. So you cannot compare to historical operating numbers. So my take on capex is that they ramp up the capex a lot during, I would think it's 2021 or 2022. They plan to ramp up a lot because they see that huge demands on all these chips. So they really want to ramp up that. And then recently, talking about recent 1 or 2 quarters, once we see all this smartphone, PC market all slow down, they actually already communicated a few times that they will cut their capex. So they lower down the planned capex, but it's still a huge number there. So I think with all these capex that they are spending, that's why I'll foresee that their revenues will be still continue at, let's say, like 20% growth over the next 2 to 3 years, because they spend first, and then all this will flow into revenue, flow into profit in the future. So I think you should see their capex and their operating numbers separately. They always spend first in terms of capex, and then they get their money back. That's why if you look at their PE, right, it's also, you need to be careful, because PE may look super good now, because what is PE? PE is essentially, you look at what's their price versus their earnings. Their price isn't that high relative to their current earnings, because they're showing good numbers. Because whatever capex that you spend, right, it won't flow into earnings directly. You actually, like, it will be like amortized over time. So imagine that you can have a good earnings, let's say like big number earnings, but out of that earnings, it's not all those earnings will flow into free cash flow, because of you have to spend a lot in your capex. So that's what I would say. For TSMC, you need to understand their capex as a size, right, relative to their business, is a very big number. So all this revenue that they receive in is the capex that they spent in the past. So as they spend a lot of capex now, it will lead to future revenue. So there's a lag effect there, and that lag could be like a couple of years, because it takes time from capex as they build their factory and so on. Maybe there's a couple of years lag. Tooling, all these things, they spend a lot on their all the EUV machines, some other machines. All this is like really big numbers. You see, right? They still recall the 100 billion capex they spent over, let's say, 3 years, right? That's 100 billions, It's a very, very big number. So that's the nature of their business. So if you understand their nature of the business, you can interpret their PE, you interpret their all these metrics in a different way. So it's a bit different compared to companies like, let's say, Apple. Apple one, you can say that it's not like that. It's not like, oh, they spend big capex now and flow in years later. It's not like that, right? So it's more like if you compare the capex number year over year, you get a more smooth out numbers for other business. But for TSMC, I would say that the capex number looks very big. It could be a concerning, let's say, if you spend the capex now, then you suddenly realize that they can't monetize all these fabs that they already built. Then this one is a much bigger problem. So I think the metrics that we should look at is their utilization. But of course, utilization on the capex is not a problem also, because let's say the capex that they spend now is mainly for the 3 nanometers, for example, right? Or even 2 nanometers. And these are the future utilizations. But when they say they have a lower utilizations, that's for 7 nanometers, which is like the past capex. So I don't know. I think this one, for those who didn't pay attention to semicon business, you might think that, oh, what am I talking about? Because of these lag effects there. So I think for foundry, right, for all these like TSMC, their business, when we say management is good or bad, it's not really like, oh, do they really have the best tech or not? Sometimes it's not about that. Sometimes it's about their what kind of information, what kind of data that they get, because they talk to each of their customer individually, and then they aggregate all this intel, And then from all this information, they have to gauge that, okay, how much demand that we will have 1 year, 2 years, 3 years, 4 years down the road. And then with that information, they decide how much capex that they will spend to make sure that all these capex, all these purchases that they make, right, is they optimize it. By optimize means that they spend just enough to have like 100% utilizations. If you spend too much, means that you are buying a expensive tool and then you put there, nobody want to order anything for that tools, right? And you don't spend too little, because if you spend too little, meaning that you actually, there's a sales that you didn't capture, and all these sales might be captured by your competitors. So how to optimize it, right? It really depends on their relationship with their clients. Means that the clients need to be honest with them, like they don't over order it and they don't under order it. So all this is really a coordination, and it's an entire sector's kind of coordination. It's just not one-to-one only. It's like aggregate. So they need to talk to each other, have a feel on what's the demand. Everyone do their research and then be frank to each other. So this is the strength of pure play foundries. They can do this. Because for other businesses, say for example Samsung or Intel, right? They can't do this, because their customer may not be 100% honest with them, because whatever information you share with them, right, they also have their IC design team that they can benefit, right? So there's some conflict of interest there that is a little bit different as compared to TSMC. So I think this one, I'll just stop here first and see anyone got any comment.
Just like to point out that it could also be possible that we have like a kind of like, I mean, the idea that the machines will keep getting better is actually an assumption. There could be a limit into like at some point, because of how expensive it is, there will be like a plateau in terms of like it's actually easier to stack more of them than to like go to a smaller node lah. So there is that idea as well, because we actually can see this from how 2008 to 2008 to around 2016 like that, whereby Intel actually stuck on that 14 nanometer node for over like 5-6 years. So and they actually improve on that 14 nanometer node to the point whereby they are the most competitive and the most efficient, and going with them was the better thing to do in terms of price to performance. Even though there are better nodes out there, or like people might create like, let's say 12 or 10 nanometer, but you will still stick with Intel because of like their technology stack and the efficiency gains from just being on their platform. To businesses that have like, say, like 4 or 5 year horizon, right? It might be actually more. They might calculate and find that it's more cost efficient to go with that stack, especially if it's a well-established stack. So right now it's more about like all these companies, right? While you are actually like all racing to see who is competing, to see who is better, right? There will be a point whereby these companies will hit a plateau and say that, okay, we are already at this level, and these other companies will find it more difficult to catch up to this level if we just optimize for this level first and squeeze out the extra gains for whatever cost that it is, rather than move to a new process or new node or something. You improve on like the other efficiencies of it. It's kind of like, if you think about it, like you hit like a TAM already, and then you don't really want to be like, wow, I still need to spend a lot on capex. Your shareholders will be asking you, hey, we are already maxing out at this particular point, and you're already the biggest. Shouldn't we be more aligned with the shareholders' interest and reward back the shareholders' money, rather than what are you researching so hard for to I know you are definitely researching to maintain your edge, but is it really necessary when you are the biggest one already and you still want to spend so much to maintain your edge against no competitor that is nowhere close to you. Yeah, that is one of the line of thinking, and it is a completely reasonable line of thinking to think that way. For now, all these data, all these things are all data driven, because the idea of like why people are going for smaller nodes and better hardware is all to do with how much data they are trying to process. So long as the data trend is going up, right? That means every year how much more data is being created and used compared to the last year. So long as this trend is going up, there is a demand for better hardware to support this. But at some point, once you see that the trend start to slow down a bit, mainly because there's only so much data that your human mind can process before you actually zone out or whatever and things. Or as you can see, you can kind of see it from like the smartphone limitation really, which is that your smartphones may be getting better and the amount of technology in your smartphones are getting better, but you start to see that even right now in smartphones for the past 3-4 years, right, there has been a heavy consolidation into the top 10 apps. That means more people spend more time using the top 10 apps compared to other apps. Even though there might be some niche apps that might be better at doing a certain thing in particular, but they rather do it on the big apps that might provide a worse service, but it's purely because it is that one app and they rather do everything through that one app. So in terms of like the smartphone, this interface, like how we use the smartphone, because it is on this smartphone usage plane, right, whereby it's two-dimensional and you can swipe up, down, left, right, and press a few buttons here and there. There is a limitation into how much information you can create and put inside this device or process using this device, because the next level leap in order to drive hardware harder would be that something that processes information or captures information much faster and higher volumes than this smartphone interface. Right now we are at this smartphone interface. That's what I mean. So I mean, obviously that's why people are looking towards like things like virtual reality or AR, that kind of things, to see whether the next level can be there. Because once you have more information coming in, then you drive towards that. You drive towards whichever platform allows people to process and create more data. That is fundamentally what the tech industry is about, which is that whoever can create and process more data is the winner. Yeah. So that is, and the smartphone limitation is that really is plateauing at this level, whereby you can see for the past 6-7 years the way we use the smartphone has not really changed. We are still using it the same few ways, that kind of things so when the technology for this like software plateaus at that point, right, then the hardware will eventually plateau at a certain point to that level. That's how I look at things. I mean, you can look. That's how I look at things when I observe the trends of the past, which is that you see like how a few prominent examples, which is first you see like before the smartphones, you have like those like Nokia phones, right? People plateau at that point whereby even though there might be other things that are there, because it's not really that convenient to process or create more information in that kind of format, then they plateau at that point until a new product like a smartphone comes in that can exceed that limit. And the same thing goes with like for computers. It was during that point whereby the Intel, the four core thing, right? People were still stuck at the creating single threaded apps and creating apps that are that for that level, and businesses, the hardware was really at that point whereby businesses haven't catch up to it yet. So therefore the hardware also decided that, hey, in order for people to use more of it, the software stack has to be more mature so that we can build the next layer. Because when you look at all these kind of things, it's kind of like how you go into any enterprise, they are trying to digitize, right? The enterprise digitizing will usually start with the same kind of things, which is like, firstly, do you have like we need to identify where are your data inputs coming in, and these data inputs coming in, can we actually put which are the databases that are being put in, and then from the database, can we actually centralize the database so that we can use the data and create like a second order like summary data of that, and then go on to perform whatever data driven products from that second order data, and so on and so forth. And that is the trend there is. So this trend will also happen in all the other industries, and yeah, that's the thing. So unless we move to like a next platform, that means a next platform better than the smartphone platform of this level of usage, right? We might actually plateau at a certain point for smartphones if we continue staying on smartphones and don't move to like some other better human data interface. Yeah.
Yeah, just now you make a point about all these like process nodes. We will stay on for some time just to mute the whatever tools that we have, right? I think that's a very good point. I just want to add on that now, because I think first thing is that in the past, when TSMC is trying to move from, I recall, let's say from 7 nanometer, I think all this few years back now. So they try to do like every 2 years, they will move to next process node and so on. I think upcoming ones, say for example, 3 nanometer, they will slow down already. They mentioned, if you look at their process roadmap, I think for 3 nanometer, at least they will have 3 iterations, meaning that they stay at 3 nanometer and then they do a 3E or 3P or whatever, meaning that there's incremental improvement there, but it's still considered as the 3 nanometer family. So they have to do that because like whenever you move from one family to the other, there's huge process, huge requirement in terms of the tooling and so on. So it's very costly. So they try to slow it down and then milk more before they move on to the next one. So that's one thing I want to point out. Secondly, I think when people talk about like R&D and then all these foundry that they move from one family to the other, they step up. They thought that R&D is always about moving to a smaller nanometer from 3 to 2 to 1 nanometer. Actually, that is just part of the entire picture, because there's a lot of R&D to actually improve the entire process within the same family. Say for example, they work, a lot of R&D is used to increase the yield. Say for example, because whatever yield that they are able to get, meaning that how much defect in the manufacturing, if you can increase the yield, actually you can lower the unit cost. And if you can get a lower unit cost compared to your competitors, means that you basically win the contract, and you are more reliable when it comes to deliver the orders. So I think that's one thing about the yield part. So they have to spend a lot of R&D to make sure yield is high, right? So that's one. Another one is that aside from all this talking about yield, right, also there's R&D to say, can we actually improve the process to make it like cheaper, for example? Like can we like streamline the cost and so on? Or I mean, this one is also something to help them to reduce the cost, because I think for all this foundry, every customer is complaining about the increase in cost. Say for example, wafer has increased a lot, right, in terms of cost. So all these have to be passed to the customers, and everyone is complaining. So I think yes, all this tooling is already at very expensive level, so they can put on some inflation in terms of all this tooling if they can justify it with higher productivity, meaning that the newer models of all these tools can produce more or can reduce the defect and so on. So then they can charge a higher price, right? So I think all this also you need to like this is when it comes to capex, when it comes to R&D. I think these are a few things that is very important, and it's as important as moving to the next nanometers now. So that's what I want to point out.
Yeah, correct. I agree with that thing. It's just that obviously it's up to like the competitors. The reason usually they try to go for like the lower nanometers is because they want to be they want to gain an edge over their competitor, and obviously, like higher density equals better. This is higher density of transistors equals better. This is a law of physics. They're trying to play the game of the law of physics, but at some point, the cost is so prohibitively expensive that investors will actually balk at it, because you want to like borrow billions. People will be like thinking, oh, do I really have that much, or should I actually go for something else that can get, because investors might be thinking short term or long term or whatever, and whether it's worth the risk reward to play this physics game instead of play the profit extraction game. That's the kind of things that they're looking at. So definitely they will plateau at some point so as to let the software or like the usage catch up to it. And you can kind of also see this in the evidence of like smartphones as well, because you can see that Apple itself is, you can start to see that they are actually slowing down their improvements to the next process node. Their smartphone, they kind of realize that they don't really need to, like, say, move towards the highest end node for their smartphones, or they can afford to draw out the cycle for a bit longer to like between like iPhone 13, 14, 15 onwards. I'm not sure exactly, but I believe like 13 and 14 is very similar, is very close compared to, like, say, the previous jumps, whereby when like 8 jumped to 10, it was a pretty huge jump, that kind of things. And then from like the X jump to 10 jump to like 11 was also kind of like pretty huge. Yeah. So they will start slowing down, because fundamentally right now when we use the smartphone, it is only those few things that we do. We type messages, we take videos and photos, and then we use a few whatever kind of like listening apps. Listening to songs, or like some kind of like tracking your heartbeat app, those kind of things. There isn't much else that you do with it. You don't really do, like, say, very complex things on the smartphone now, and this is a limitation of how the interface is. It's not like something whereby you can use it to like do hardcore calculation things, or like do more complex things, because the smartphone interface only allows you to use your fingers in this particular way, and use your eyes in this particular way, compared to like other platforms that might be developed in the future. Yeah.
Okay, thanks. I'll comment on one more questions from Hayden, and then the closing questions I'll come back to you, YCX, because I think Chicken has one question for you. That's closing questions. Let's finish up the TSMC.
Sorry. Can I add one more point?
Yeah, sure.
Yeah, I think because manufacturing concerns, right? The default way of looking from a finance point of view is looking at the free cash flow. So free cash flow technically defined as the operating cash flow minus the capex. So for a manufacturing concern like a TSMC, right? I think when we keep looking at their investment, when we are worried about whether this investment will make sense in the longer run, I would think that we should focus on the free cash flow for this sort of concern, to see whether, because they are investing ahead for future returns, which will increase their operating cash flow going forward, technically, if it's done well. So if this has been, if you look at TSMC record in terms of the free cash flow, it has always been positive, meaning that what they have done earlier on in terms of the investment, the capex, these sort of things, is yielding the result to sustain the business going forward in terms of the operating cash flow coming back later on. And that allows them to continue to do the investment. So in a case where they do the investment wrongly, right, over time, right, you will start to see the free cash flow start collapsing, which will means that it will be a concern at that juncture. So rather than looking at So we have to give some credit to the past track record on how they maintain that positive cash flow, and to see whether any disruption to that, and that will also disrupt on later on their, because whatever leftover from the free cash flow may come into the share buyback and the dividend itself, the rewards back to the shareholders.
Yep. Totally agree. It's just that I want to point out that sometimes even if you see some drop in the free cash flow, it is not a big problem if you still have confidence in terms of their current capex, because your operating cash flow could be like positive because of your good past investment. But if they foresee that the sales could be going up, like let's say 50% of year on year for the next 5 years, they will really spend big on their capex, and that could lead to negative free cash flow as well. But you need to have some confidence in terms of how they're deploying the current capex. That one is that we have no way to actually prove that, because this is essentially their future revenue that will come in, right? And all this depends on the orders, because customer also can cut orders. So sometimes it needs some confidence in terms of how management is deploying their capex. So that's my add-on to that. Come back to comments by Hayden. So let me read out the comments. There are two types of capex, right? One is maintenance, which must always be there. Another type that is for expansionary. Doesn't top-tier foundry also need to always advance up the ladder of technology? Hence, continuous capex spending is necessary. Historically, TSM has never decreased their capex quantum every year if we track it since 10 years ago. Okay, so that's his comment. So I'll just say that for their capex, of course, there are the maintenance one and there's expansionary one. I believe their maintenance capex is, I don't know how much is the amount as of now. I think it should be some lower numbers. When we heard about numbers, it's like what, 30-40 billions capex, right? I believe that is mostly expansionary, and the expansionary one is also not everything is like the leading edge one, because they also expand on their mature nodes. Say for example, like what, 28 nanometers. There's still some expansionary for those mature nodes one. So let's take it as like bulk of the capex is really for the expansionary capex. So that's one comment. The other one is that, do they really have to like advance their ladder of technology every year? I think the answer is yes. So they cannot just say, okay, I'll just stop the capex and I will milk whatever that I have for the foreseeable future. If they do that, right, then just have to close eyes for 3 or 5 years, then suddenly Samsung become number one and TSMC won't be able to catch up anymore. So that is just the economics of their business, is that this advance of technology will be here every year. They have to up all this capex every year. So this one is just part of the economics. You just have to be okay with that. The good thing is that as they spend all this capex, as they maintain as like one of the top foundry, all this actually will lead to revenues, and then revenues will lead to earnings and free cash flow in the future, because they are not going to spend capex to ramp up a business that is unprofitable. So that's not the case, right? They always price it at a premium. In fact, I recall that I think Maurice Chung mentioned in the past that they are okay to negotiate with the customer. They are okay to negotiate everything except for the price. So they will always price their product at a premium. But in return, what the customer can be assured of is that the reliability is there, the quality is there, the value adds is there. Like sometimes they have all this, like with their customer, they also try to R&D the same thing, and then they give something that's good now. So they have some feature or anything. I don't know the details. It could be quite technicals there, but they always try their best to fulfill the customer demand and try to like give the good stuff to their customer, make their customer happy. That's why customer like Apple, once they start to use TSMC, they are not getting out. So that's the things that they promise. But when it comes to pricing, they are not going to say, okay, we price it cheaper. We deliver the bad stuff, but we are cheaper. That's not TSMC way of managing their business. So that's thank you so much to Hayden for asking these questions. Yeah, so I'll close TSMC here because I want to go to the closing questions. We could spend some time on this also. Depends on YCX. So question from Chikeng. I think it's Chikeng, right? CK. I hope I get the right person. Wanted to ask YCX, what will be your signal to pivot away from energy or oil and gas sector, or is it a long-term play? So over to YCX.
It's more of like a volatility play. So I don't foresee that oil will fall that drastically, because I mean the only way it will fall that drastically is another pandemic come in, I suppose. Yeah. Even in times of war usually oil prices go up. So it will really take a crisis to 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 do something like that, like which is like the pandemic kind of things. And another thing about the pivoting would be that it's more of looking at the oil industry and whether their overall PEs have all gone up drastically. So if their PEs are going up too high, then there are two things I would do. One thing would be to actually sell calls on them. Yeah, because it is a volatility play after all, which is that if I can reap like some kind of yield on it by just selling calls, and if it hits that desired price of mine, which is like say 20% increase, 20% increase already, right? Then I don't mind selling it at a high enough price and moving that money into like other instruments, which is most likely going to be, I mean, for now, because the interest rate is still high, for now, if there is that kind of potential, I will move it into bonds or other long-term fixed instruments for that portion. Yeah. So it's most likely that I will sell covered calls on those things, or I will just sell it outright and move the cash into bonds. Yeah, that's my play for the energy that I'm doing. Yeah, and that is for energy. Because energy, there are the few kinds, which is that there is just buying the commodity itself, so like the futures. There is also like buying the companies, and there is also buying like the alternative fuels. That means there isn't just oil. There's natural gas. There is uranium kind of things. So for uranium itself, I'm putting it more as like a longer term play. I just hold like a very small percentage of uranium that is just there as like I'm still deciding what to do with it. Yeah, it's either to increase the positions or to as kind of like a hedge for all the other energies. Then there's also natural gas, which is more of like a hedge against disaster. Yeah. So natural gas is that. So for this kind of like hedge against disasters kind of thing, the moment the volatility is up, I'm not going to hold it like long term, because if it's currently if it has a spike up, then I would definitely sell, because so long as I'm in a profit for this kind of like I accumulate them at cheap enough prices for all these like natural gas kind of things, then I'm just betting on like the reversion to mean, whereby if there's a high volatility spike, I would just sell calls on it like massively. Yeah. So to gain some kind of profits from it. Because for commodities play, I know that it's not a good idea to hold on to them for too long. They will usually revert to mean that for commodities. Yeah, but for like the companies that mine or process these commodities, that will be more on like what is their industry, how their industry is performing, and how they are performing relative to their industry. So they are performing too well, then it's time to like start to convert them and reduce the size and reduce the size of that in my portfolio already. So that's the things that I have, optimistically speaking. So then the other thing would be like the pessimistically speaking, that let's say somehow the energy sector starts to get very cheap, and if energy sectors get very cheap, there are a few things at play here, because if energy sectors get very cheap, I would think about like how that will work out in the overall macro environment, which if you have very cheap energy, then you are going to have a lot of production, and having a lot of production means like means like all your manufactured goods are definitely cheaper because you have more production. Then in that case, is more about like whether whether the economy can sustain that thing. Because basically I don't think it's possible, because if let's say there's a lot of high manufacture and like cheaper goods and things, and people buy more and things, inflation is going to go way up, and energy prices are very sensitive towards this kind of things. So I'm still trying to think about, is there a scenario whereby energy prices go down and inflation goes down and Fed funds rate goes down together? If they all do that, then definitely something else must be going up, which I would think would be tech, since I'm really heavy tech. So yeah, there's that. That's the way I'm thinking in terms of like how energy complements tech. Yeah.
Okay, thanks. Just to be clear, you don't have stop loss on your like all these energy picks, right? Do you have stop loss helping you with the decisions execution?
More of like, what am I going to, because the idea is that when I have like this position in energy, right? It is like a hedge and a complement towards like the everything else that I buy, which is like tech. And I mean, if I look at it like how a sector analysis or industry analysis guy would look at it, they would say that my portfolio is very heavy tech. And yeah, I mean, they would think that way lah. So in terms of that way, of course, I'm trying to like hedge against it by also getting energy. And obviously it's a hedge against like the portfolio itself is like mainly, if it comes down to it, is mainly cash, energy, and tech. It's like these three main things lah, if we look at it this way. So long as I'm growing it overall, right, in terms of like it's more of like a portfolio balancing thing, which is that I think that obviously some people might look at it differently. They might think that my portfolio is entirely valued in cash, so I focus on hitting that cash number up all the time. But the way I look at it is that I'm focusing on growing like all three together at the same time, and overall to acquire more of these three. Yeah, so there might be some years whereby it's down, then I accumulate more of that, and eventually hope that it goes back up. And for that itself, I don't have a stop loss. Yeah, because there's no point in having a stop loss for me. I mean, if it goes down to it can't necessarily go down to zero unless the company is committing fraud or something, right? So if it's not going to go, someone will definitely value it at a price to book ratio at some point, which wouldn't make sense because it's a company that is generating profit. Then why would you value it at price to book? That doesn't make any sense at all. So there is that factor, which is that. So unless the companies commit fraud, then that's another thing altogether. But generally, we don't talk about like public listed companies that are so big. I mean, it is possible. I wouldn't say it isn't impossible, but how do you actually go and look at that and think about that they will commit fraud? Because you must be like auditing them like almost 24/7 in order to know whether they have potential of committing fraud in some way. That's my view on things.
Okay, got it. Thanks a lot for the comment. Okay, I think we will close the call now. Just because I think quite a number of participants also left already, go for lunch already. Thank you so much to Maximus, to YCX, for joining the session and then sharing your views. Thank you so much. Then we catch up again, okay? All right, then I'll close the call here.
Thanks for organizing. Bye-bye.
Thank you. Bye-bye.